Imagine investing your savings into a dream of a car that never needs to be plugged in, powered by the sun. Now imagine watching that dream evaporate in a single day as 80% of your investment vanishes. That's exactly what happened to over 20,000 small investors in Aptera Motors. In a world of financial noise, let's find the signal. Welcome to Smart Money Sense. This isn't just a story about a futuristic-looking car. This is a story about a $1.3 billion valuation built on hope, a catastrophic stock market debut, and a trail of financial red flags that almost everyone missed. Today, we are conducting a complete Aptera Motors financial analysis to uncover the truth buried in their financial statements. We'll expose the Desperation financing deal, keeping the company alive, mathematically dismantle their legendary solar range claims, and deliver a final verdict on the Aptera bankruptcy risk. This is the deep dive you need before even thinking about the SEV stock. Let's start with the event that shattered the illusion, the direct listing. On October 16, 2025, Aptera listed its shares on the Nasdaq. For years, crowdfunding investors had poured $150 million into the company, at valuations climbing as high as $1.3 billion, or about $40 per share. But when the stock finally hit the open market, there were no buyers at that price. The stock immediately collapsed, closing the day down over 60% at just $8 a share. A catastrophic loss for those who believed the hype. But for anyone who had read the financial documents, this was not a surprise. It was an inevitability. To understand why, we need to look past the sleek, three-wheeled design and analyze the engine that truly drives any company, its finances. Aptera has been in development since 2019, and in all that time, how much revenue has it generated from selling cars? According to their own SEC filings, the answer is exactly $0. Zero. Let that sink in. 6 years, $150 million raised, and not a single production car delivered to a paying customer. Instead of revenue, the company's income statements show a torrent of losses. In 2023, Aptera lost $59 million. In 2024, it lost another $35 million. And in the first 6 months of 2025 alone, it burned through another $23 million. The company is burning through cash at a rate of over $1.2 million every single month. With only $13 million in cash left as of June 2025, the company has a cash runway of less than 1 year. This dire situation is why Aptera's own auditors have issued a going concern warning, a formal declaration that there is substantial doubt about the company's ability to even stay in business. This is the biggest red flag in finance, and it's waving right in our faces. So how does a company on the brink of insolvency convince anyone it's still a viable business? This brings us to our next major red flag, the Desperation financing deal. Just 3 days before its disastrous direct listing, Aptera announced a $75 million equity line of credit, or ELOC, with a firm called New Circle Capital. On the surface, $75 million sounds like a lifeline. But the devil is in the details of how an ELOC works. This is not a $75 million check. Instead, Aptera can sell newly issued shares to New Circle over time, at a 3 to 4% discount to the current market price. Think about what this means. New Circle Capital isn't a long-term investor. Their business model is to immediately sell those discounted shares on the open market for a small, quick profit. This creates what's known in finance as a death spiral. Aptera sells shares, New Circle dumps them, the stock price goes down, and then Aptera has to sell even more shares to raise the same amount of money, accelerating the dilution and pushing the price down further. It's a high-risk, highly dilutive form of financing, used by companies that have no other options. The fact that this was their only path to funding right before their public listing tells you that no serious institutional investor was willing to touch the SEV stock. This isn't a growth strategy, it's a survival tactic, and it comes at the direct expense of existing shareholders, especially the crowdfunding investors who are now facing massive dilution on top of their 80% paper loss. If you're finding this Aptera Motors financial analysis valuable for cutting through the marketing hype, do me a favor and hit that subscribe button right now. We post deep dives like this every week to help you protect your money from precisely these kinds of situations. Becoming a smarter investor starts with knowing what to look for, and there's a lot more to uncover here. Now, let's talk about the company's core marketing promise, the very foundation of the Aptera dream. The claim of getting 40 miles of free driving range per day from its solar panels. It sounds incredible. Many people drive less than that daily, meaning they might never have to plug the car in. The problem is, this number appears to be a systematic and material misrepresentation. A lie. Here's how Aptera gets to 40 miles. In their own video, co-CEO Steve Fambro explained the math. The solar panels generate a peak power of 700 watts, for an equivalent of 5.7 hours a day, generating 4,000 watt-hours of energy. The vehicle is claimed to be incredibly efficient, using only 100 watt-hours per mile. 4,000 divided by 100 equals 40 miles. Simple, right? Wrong. Every single one of those variables is misleading. First, the 700-watt peak power. In a January 2025 interview, Aptera's own lead solar engineer, Reed Thurber, admitted the highest power they've ever seen is almost 500-ish watts, and only in specific conditions. What were those conditions? Leaving the rear hatch of the car open to get a better angle to the sun. This is completely unrealistic. A more realistic peak power is closer to 400 watts, a 30+% overstatement by the company. Second, the 5.7 hours of peak sunlight. This is equivalent to the sunniest deserts on Earth. A car parked in a typical suburban driveway will get far less due to shade from houses, trees, and clouds. A realistic assumption is closer to 4 hours per day. Finally, the 100 watt-hours per mile efficiency claim. This has never been validated in a production intent vehicle. The one time Aptera reported a number, it was 122 watt-hours per mile, and they achieved it by driving on a route that went downhill over 7,000 feet in elevation, artificially boosting the efficiency. A realistic flat road efficiency is likely closer to 150 watt-hours per mile, which is still world-class but dramatically changes the math. So let's redo the calculation with realistic numbers. 400 watts of power for 4 hours a day gives us 1,600 watt-hours of energy. Divide that by a realistic efficiency of 150 watt-hours per mile. The result? 10.6 miles of solar range per day. Not 40. 10. That's 73% less than what they've been advertising for years. This isn't a small exaggeration, it's a deception that goes to the very core of the product's value proposition. Okay, so the finances are a disaster, and the core marketing claim is misleading. But surely they're about to start production, right? That's what they've been saying for years. In 2021, they said production would start in 2022. In 2024, they said $60 million would get them to production by the end of the year. Now, in late 2025, the co-CEO says they are 9 to 12 months away from starting production. This moving goalpost is another classic startup red flag. Even more concerning is where they plan to build these cars. Their production facility is a 77,000 square foot building in a suburban California office park. For comparison, real EV factories are millions of square feet. Lucid's initial factory was 900,000 square feet. The Aptera facility lacks the space for a real assembly line, parts inventory, truck loading docks, or even employee parking for a scaled manufacturing operation. At best, they might be able to hand-build a few hundred vehicles a year at this location. This means no economies of scale, incredibly high per-unit costs, and no hope of ever fulfilling the 50,000 refundable $100 reservations they boast about. This isn't a factory, it's a workshop. This brings us back to the stock market. Why would a company so far from production and with such weak finances choose to go public via a direct listing? A traditional IPO raises capital. A direct listing does not. It simply allows existing shareholders, like the founders and early employees, to start selling their shares. And unlike a normal IPO, there was no lockup period preventing insiders from selling immediately. The only logical conclusion is that no reputable investment bank was willing to underwrite a traditional IPO for Aptera. They knew institutional investors wouldn't buy the stock at the inflated $1.3 billion crowdfunding valuation. So, the company chose a direct listing, which provided an exit ramp for insiders while leaving the 20,000 crowdfunding investors to absorb the inevitable price collapse. This story is sadly not unique. The EV startup space is a graveyard littered with companies that had big dreams and flashy prototypes, but failed to navigate production hell. Nikola Motors, which filed for bankruptcy in February of this year, was once valued at $27 billion. Lordstown Motors, Fisker, Aptera, all bankrupt. Sono Motors, another solar EV startup from Germany, followed an eerily similar path. It raised money through crowdfunding, went public, and then killed its car program just 3 months later before filing for insolvency. Aptera is exhibiting every single warning sign from these failed companies. No revenue after years of promises, consistently missed deadlines, a high cash burn rate, reliance on desperation financing, and a valuation completely disconnected from reality. So, what's the final verdict from our Aptera Motors financial analysis? Aptera is not a viable investment. It is a company in critical financial distress, with a high probability of facing bankruptcy within the next 18 months. The $75 million credit line is not a solution, but a dilutive bridge to nowhere, and the company's core technological claims appear to be significantly exaggerated. For the crowdfunding investors who back this company, this is a painful lesson in the dangers of investing in pre-revenue startups based on marketing hype rather than financial fundamentals. For anyone else considering the SEV stock, the message from this analysis is clear: stay away. The risk of losing your entire investment is exceptionally high. It's crucial in today's market to look beyond the exciting story and dig into the numbers. If this breakdown helped you see the full picture, hey, please consider liking this video and sharing it with another investor who might need to see it. Your engagement helps the YouTube algorithm show this critical analysis to more people, protecting them from potential financial harm. And I want to know what you think. What was the biggest red flag for you in this Aptera Motors financial analysis? Drop your thoughts in the comments below. I read and respond to as many as I can. Now you have a clearer picture of Aptera's financial reality. But the learning doesn't stop here. To keep building your financial sense, watch this video next. And make sure you're subscribed so you never miss an insight. This is Smart Money Sense.